Most income investors are paying taxes on their distributions that they don't have to pay. There is a classification in the tax code, used quietly by the wealthiest income investors for decades, that lets you receive your monthly income, reinvest every dollar, and report nothing to the IRS until you decide to sell. And in the right structure, you may never pay that tax at all. It is called return of capital. Most people have heard the term. Almost nobody has had it explained to them correctly. That changes in the next 8 minutes. Here is how most income investing works for tax purposes. You receive a distribution. The IRS classifies it: qualified dividends, ordinary income, or something else. You owe tax in the year you receive it. If your fund pays 10% and you're in the 22% tax bracket, you're not actually compounding on 10%. You're compounding on somewhere between 7 and 8% after the IRS takes its cut. Every distribution is a taxable event. That gap is not trivial. Run it forward 20 years with DRIP reinvestment, and the difference between compounding on 10% versus 7.8% is not a rounding error. It is a material difference in ending wealth. The structure of how your distributions are classified matters as much as the distribution rate itself. Return of capital is a tax classification, not a commentary on fund quality. When a distribution is classified as return of capital, it is not treated as income in the year you receive it. Instead, it reduces your cost basis in the fund. No taxable event at distribution. The IRS defers the tax question to the future, specifically to whenever you sell your shares. There's a misconception that has followed ROC distributions for years. The criticism goes like this: the fund is just giving you your own money back. It is eating itself. That framing conflates two completely different things: the tax classification of a distribution and the health of the underlying fund. A fund genuinely destroying itself shows a declining NAV over time. A fund that pays ROC distributions while maintaining or growing its NAV is not eating itself. It is generating income through a mechanism: options premiums, managed payouts, or active portfolio strategy, and the tax code classifies that income as a basis reduction rather than ordinary income. The criticism and the classification are separate questions. Most people confuse them. The test is simple. Track NAV over time. If it holds or grows alongside consistent ROC distributions, the fund is healthy. The classification is not a warning. It is the architecture working as designed. Here's what most ROC coverage misses entirely. There are 3 layers to this structure, and most retail investors only understand the first one. Layer 1, tax deferred. Today, every ROC dollar you receive is a dollar on which you owe no tax in that year. Reinvested immediately through DRIP, that full dollar goes to work. Not 78 cents, not 82 cents, 100 cents compounding. The tax is deferred, not forgiven. But deferred is powerful. A dollar compounding for 10 years at 10% becomes $2.59. A dollar immediately taxed at 22% becomes $2.02 over the same period. The gap widens every year. Layer 2, pre-tax DRIP compounding. As ROC distributions reduce your cost basis month after month, and you reinvest those distributions into new shares, you're building a larger position on a shrinking cost basis. The deferred tax liability grows slowly. The share count grows faster. As long as the fund's NAV holds, you are compounding on pre-tax dollars across a growing number of shares. This is the layer that traditional dividend investors who pay tax at distribution never access. Layer 3. This is the one almost nobody talks about, and this is the beat that I want to sit with for a moment. When you hold an asset that has accumulated a deferred tax liability, years of ROC distributions reducing your cost basis, and you pass that asset to your heirs, the tax code resets the cost basis to the fair market value on the date of death. The entire accumulated deferred tax liability is eliminated. Not deferred again. Eliminated. Your heirs inherit the full value of the position. The IRS event that was deferred across decades of ROC distributions never arrives. Wealthy estate planners have built strategies around this provision for decades. It is not a loophole. It is the tax code functioning exactly as written. Most retail income investors have never had anyone explain to them that the structure they are building today could transfer to their family completely tax-free. That is the three-layer architecture. Tax deferred today, pre-tax drip compounding across the accumulation phase, generational transfer with the deferred liability eliminated at the step up. The funds in this channel's income floor generate ROC through three distinct mechanisms, and understanding which mechanism applies to which fund is part of reading your 19A notices correctly. Covered call funds like GRNI generate income primarily through option premiums, which flow through net investment income. The 19A notices have confirmed 100% ROC classification in all but two distributions since inception. 2 months came in at 0%. The remainder, 100%. That consistency is what makes GRNI the anchor of the income floor sequence. Call spread funds like ROCY and ROCQ generate distributions that fall structurally outside NII. The net premium from a call spread is not interest, not dividends, not NII. ROC is the classification by default. The fund's notices have confirmed 97% or above ROC across every distribution. Managed distribution funds like TPAY target 100% ROC as an explicit design commitment from Roundhill. That design intent is documented and consistent, with the honest note that TPAY has not yet been through a full annual reset cycle, so the track record supporting that commitment is still building. The mechanism is sound. The long-term data is not yet there. Each of these funds has a dedicated deep dive on this channel. Links are in the description. One risk worth naming directly: cost basis cannot go below zero. If you hold a position long enough, accumulate enough ROC distributions, and your basis reaches zero, subsequent distributions become taxable capital gains rather than tax deferred. For long-term holders in this position, that treatment is often more favorable than ordinary income rates. But it is a tax question with individual variables. If you are approaching zero basis, that is a conversation for your CPA, not a YouTube video. Know your cost basis. Track it month to month. That discipline is part of running this architecture correctly. Here's the parallel that keeps this in perspective for me. Every training session produces adaptation that is invisible in the moment. You do not see the muscle built from a single workout. You see it after 2 years of consistent progressive overload, and then suddenly you cannot miss it. ROC compounding works the same way. The deferred tax advantage, the pre-tax drip accumulation, the growing share count, none of it is dramatic month to month. It is invisible accumulation. And then, at the transfer event, you see what 30 years of invisible compounding actually built. The architecture only works if you hold and do not interrupt it. If this framework is useful, hit like. It helps people building the same system find this work. Every fund in the income floor generates ROC differently, and the deep dives on GRNI, ROCY, ROCQ, GPIQ, GPIX, and XPAY versus TPAY are all linked above. Subscribe if you want the next deep dive when it's ready. Drop a comment. Did you already know about the stepped up basis piece? Or was that new? I want to know how many of you are already tracking cost basis month to month on your ROC positions.